Valuation ratios translate raw financial data into standardized metrics that let you compare companies across industries in different time periods. Price to earnings, price to book, enterprise value to EBITDA, and the PEG ratio each measure a different dimension of value. None tells the complete story in isolation. Watch the ratio dashboard populate with 4 metrics simultaneously. A price to earnings ratio of 34 is expensive for a utility but potentially cheap for a software company growing at 20% annually. Context from the sector and growth rate transforms the meaning of any single ratio. The PEG ratio divides price to earnings by expected growth rate, and a PEG below 1 may signal undervaluation relative to future earnings. The stock trades at 34 times earnings with a 14% expected growth rate, producing a PEG ratio of 2.4. Price to book is 8 times, high relative to asset-intensive peers. But enterprise value to EBITDA is 12 times, which is reasonable for a software business with high recurring revenue and low capital expenditure requirements. Sector context changes the interpretation of every single ratio. You compare the target company to 5 sector peers using all 4 ratios simultaneously. 3 of the 5 peers trade at lower price to earnings multiples with similar growth rates. The target company's PEG ratio is the highest in the peer group. Either the market expects significantly faster growth than consensus projects, or the valuation is stretched relative to peers. This comparison triggers deeper due diligence before making any position decision. Ratios only make sense in context. Compare to sector peers and the company's historical range. A ratio tells you what to investigate next, not what to buy or sell.